You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
You wanted it, you got it. A radio program that helps teach you options trading inside and out, basic to complex. This is Options Bootcamp. Remember, options involve risk and are not suitable for all investors. Now, let's get you into peak options trading shape. Here are your Options Bootcamp drill instructors, Mark Longo, Dan Passarelli, and John Critchley.
All right, everybody, welcome back to Options Bootcamp, the program here on the old Options Insider Radio Network, where we break down you scrawny retail stock traders and rebuild you into buff, dangerous options traders. My name is Mark Longo from theoptionsinsider.com, as well as, of course, from the ever-exciting Options Insider Radio Network. I know a lot of you guys have been reaching out to us saying, hey, we need some more boot camps. We need some more boot camp in our lives. Well, we're happy to get another episode out for you. Our first here of the new year 2016. A lot of great options education to get to on the old program. And of course, on this network, we produce a lot of fine programs, not just this here fine program, full baker's dozen of them, and we have 9 years worth, yes, this January, 9 years worth of content for you guys to peruse, the best place for you guys to find that, as well as, of course, all of the archived episodes of Options Bootcamp. So if you want to go review an old topic or want a refresher on something while you're commuting or driving or something like that, we're happy to help. Just surf on over to theoptionsinsider.com. Click on the Insider Radio Network tab, top left corner of the homepage, and you're pretty much good to go, of course. If that's too much work for you, want to just find it in your platform of choice, well, then iTunes, TuneIn, Stitcher, etc., it's all there, including our mobile app available for iOS, Android, and the Fire OS. No shortage of ways for you guys to check out all of the great content on this program as well as the rest of the network. And joining me here yet again, we couldn't shake them, listeners, even though we tried, my boot camp fellow drill instructor here, Mr. Dan Passarelli. Dan, welcome back to the program, sir.
Mark, it's been a long time, and it is great to be kicking the year off right.
Yeah, the old drill instructor parade ground here has been kind of silent of late. You and I have been busy on a number of different things. We want to make sure we get our boot camping in. So are you ready, sir? Do you have your whistle and indeed your black hat?
I am indeed ready.
All right, then without further ado, let's dive on into it. Last time we did a big mail kind of question palooza. We also did a big one on binaries recently, and we have something listener inspired this time to kick off the show. So without further ado, we're going to get into our basic training segment.
All right, Boot, it's time to get in line. What you're going to do is learn. You're going to learn how options work. Do you hear me? Yes, sir. You're going to learn options trading inside and out, basic to complex. There will be no failures. Do you hear me? Yes, sir. Pull in. Prepare to learn. Yes, sir.
All right, everybody. Welcome to Options Bootcamp Basic Training. This is, of course, the portion of the program where we break down usually some basic options concept and tell you how you can incorporate them into your portfolio. Today's a little bit different. This is more of perhaps advanced training here because we're breaking down a topic that's a little bit outside the normal scope of our basic training segment. But the quite fact of the matter is that you guys really wanted to know about this. It's funny, Dan, you know, in our 9-year history now on the website, on the network, I can never recall receiving any questions on this topic. And then in the last few months, all of a sudden, they started coming in like mad. Maybe there was a webinar out there or a book released on these. I'm not sure really where they come from, but they're coming in, so we thought it was worthy of devoting a bit of a segment to it. What are we talking about today, listeners? Well, that most esoteric of topics, second-order Greeks. It's even for Dan, the guy who wrote the book on the Greeks, it's not a topic we discuss very frequently. It just doesn't come up that often. But a couple of questions coming in. The first one coming in from Brian F. He wrote this one specifically for you, Dan, so put on your listening cap. He writes, my question is for Dan, so I'll just sit back. He says, I listened to the Bootcamp shows and recently had a question about gamma. Imagine my surprise when I learned that there are other secondary Greeks and even tertiary Greeks. What this? Are you holding some Greeks up your sleeve, Mr. Black Hat? So my question is, what are these Greeks, but more importantly, who uses them and why? Does a retail mope like me need to know about these Greeks? We also had a similar question from Charlie C. He writes, hey, do second-order Greeks have any relevance for retail traders? So I don't know what it is, something in the water, Dan, but apparently our listeners and the retail audience out there at large has second-order Greeks on the brain these days. I'm not sure what it is. So since you wrote the book on the Greeks, quite literally, and also they're writing to you, so I'll let you run with this one, sir. What's your take on these second-order Greek things?
Well, it's funny because, this is Options Bootcamp, which, I'm not like a military guy or anything, but I'm familiar with the concept of Bootcamp. It's like, you get all the people who are wet behind the ears, like all the brand new recruits, and, you get them started. That's the whole concept of this show. And this is kind of like, welcome to boot camp. Okay, we're going up in a plane. I'm going to push you out into a jungle amid heavy fire. Like, that's basically what we're doing here
Boot
today.
Camp Masters Edition.
Right, exactly. So not quite boot camp in the classical sense, but these are some good and interesting questions, good things to talk about. Mark and I were joking, earlier when we were talking about the show. Mark was like, yeah, maybe we can just do like 20 minutes or 40 minutes. And I said, oh yeah, I'll do a 1 hour soliloquy all on this. And I was, because this is online radio, you have to kind of have some mental images. So I was picturing, like, what is that Peanuts Christmas thing where like Linus talks about the spirit of Christmas and like the light shines down
we'll
on
play
him.
Some light music in the background for you.
Yeah.
Snoopy will dance in the background.
Right. So that's kind of what I wanted you guys to picture. But like what I'm actually picturing is more like Mr. Smith Goes to Washington, where everybody goes, oh, crap, and runs out of the room, We're going to be talking about second-order Greeks.
Yeah, the second-order Greeks tend not to pack them in usually, on a regular basis. But clearly our listeners want it, so we got to give the people what they want, right?
Yeah, got it. The show must go on. All right, so let's talk a little bit about this. I don't know if I should give you the punchline or the joke first. Let's stick with the joke. So, okay, I'll roll out the story here. So basically, I talk about the Greeks all the time on this show. Even though it is boot camp, Greeks are not basic. Greeks are essential tools. You can't trade options without understanding your risks and reward potential. Otherwise, you're going to lose money. So I talk about the Greeks all the time to help everybody understand how options work. And the basic Greeks are really delta, theta, and vega. Delta probably the most important, theta probably the second most important, vega probably the third most important, but they're all important. And then, I classically throw gamma into that mix as sort of the fourth most important Greek, but now technically gamma is what you would refer to as a second order Greek. So the difference here is first order Greeks, the regular old Greeks, are ones where one thing affects the value of your option. So delta, when the underlying stock moves, the value of your option changes. By how much? Well, by the amount of the delta. With theta, as time passes, the value of your option changes. Well, by how much? By the amount of theta. And then with volatility, when volatility changes, your option value changes. How much? By the amount of vega. But that's all kind of fine and good. And I know some people who are new to options, they're like, holy cow, that's really complicated. Baby, that ain't the half of it. Because all these Greeks are really dynamic. And probably a lot of you guys are familiar with that concept already. Like, I bet a lot of people who are into option selling, like, you understand that idea that you'd rather sell a shorter term option than a longer term because the theta is higher for shorter term options, right? And you can kind of logically deduce that, well, okay, so that must mean that as time passes, theta gets bigger. So there's like just a classic example that you could probably figure out on your own if you haven't already. You'd eventually figure it out on your own, like, oh, so theta changes as time passes. So now we're not talking about how the value of an option changes as an influence changes, time, direction, or volatility. We're talking about how one of the Greeks change as one of the influences change. And that's what's known as second order Greek. So I mentioned that gamma was the second order Greek that I tend to talk about a lot. So what is gamma? Gamma is the rate of change of delta as the underlying stock price changes. So you guys kind of see the difference. It's the second order Greeks are how the Greeks change as these influences change.
It's funny that, we don't really classify gamma that way, but you're entirely right. It is indeed a second order Greek in the literal definition of it. It's the only other Greek, at least of the traditional four, if you lump in row 5, Greeks, that actually relates to the other Greeks. The rest are all talking about some other risk factor. So that's something interesting in and of itself, that, these are gamma kind of being in that of itself. I'm getting the feeling that's not what he's writing about. He's not writing in about gamma, even though he did say he had a question about gamma. He doesn't say what it is, but he did say he had a question about gamma. But yeah, he wants to get into the deep, dark, mysterious realm of what Vama and Vana and all that fun esoteric stuff, sir.
Oh, Vana. Well, let's see here. Yeah, well, let's talk a little bit about that. Now, okay, so here's where I'll give you the punchline before the joke a little bit. I'm going to tell you that for probably all of you, this is going to be interesting stuff, but not very heavy on the utility end of it. Probably because this is boot camp and we attract probably beginning to intermediate level traders, although I know there's a lot of advanced people who watch it too to learn stuff because we go there. My sense is that a lot of people who listen to this show, if implied volatility changes, you don't even notice how Vega affects your option. Like that stuff, if you're trading a 2 lot or a 5 lot and implied volatility falls 1 point, you're not going to notice it. You're not going to notice how sometimes some of the first order Greeks affect your positions. Now, for how much the second order Greeks affect your positions, that's a much, much smaller, like it's 1/100th of the effect of a first order Greek on your position. So like if you don't on a regular basis say, oh, well, look, I lost this amount on implied volatility changing because my Vega is this. If you're not there right now, then, well, I don't want to say none of this matters because then you'll just stop listening. But it's less important to somebody who trades less than 500 contracts at a crack. That being said, let's chat about it because you will learn something even about trading first order Greeks by learning about the second order Greeks. So the story that comes to mind, this is in, I want to say it was maybe early 2008. Before the during the financial crisis, I think. Either right before or during. I kind of forget. It was, 8 years ago or so, and traders have short-term memories. I can't remember what I had for breakfast today, so I don't remember the exact time. But I had a stint trading on the Chicago Board of Trade floor Was it still the Board of Trade back then, or was it part of CME Group? I think it was part of CME Group back then.
It was 08 timeframe?
Yeah.
Yeah, I think they had just joined the large empire of CME.
Yeah. So I was actually trading in the grains, but I was in there with a lot of other commodity. I was in an office with a lot of other commodity options traders. And somebody was telling me this story about a treasuries options trader. I don't know if it was a 10-year bonds, probably 10-year, who lost something like 10 million bucks or something. I don't know. I mean, I'm kind of making up this number, but it was a profoundly large number. A bigger number than, well, let's say a bigger number than I ever lost in a day. Probably bigger than all the losses I ever had in my entire trading career, I imagine. Gigantic one-day loss. And we're talking about it, and I think I was talking to the company risk manager, as I recall, and he was saying, yeah, so this guy was 100% delta neutral, and I think everybody probably understands what that is, right? I mean, stock goes up or the underlying bonds in this case go up or down. You don't make or lose money. He was flat theta, so, I mean, in a one-day loss, you can't assume you're going to lose 10 million bucks in theta anyway, but he was flat theta. He was flat vega, totally flat vega, like that means implied volatility goes up or down. You don't make or lose any money. But somehow he lost 10 million bucks in one day. And again, I'm kind of making up the exact number, but a profoundly large number into the seven figures or eight. So, the question was, as the risk manager is being sort of coy talking about it, like, how did this happen? Well, here's what happened. The vertical skew changed. And I don't know, I forget if it was the upside or the downside collapsed or exploded, one or the other. I imagine, well, I don't know what it was, but either way, the skew changed profoundly in one day. Somebody either came in and bought or sold a whole bunch of calls or puts, and the vertical skew changed profoundly. So flat delta, flat theta, flat vega lost a boatload of money because of skew. And so the question that this risk manager was dealing with was, well, I'm the risk manager. How do I help my traders protect against that? How do I help my traders identify their risks so that they can avoid these situations? I mean, that's the role of Greeks in general, right? And so the answer was, I believe he called it Zeta. Now, this is kind of, frankly, I'd never actually used Zeta myself. I believe he called it Zeta. But it was, I guess you might consider that maybe a third order Greek. And that measures your position's sensitivity to a change in the vertical skew. And had this trader looked at his Zeta, he would have realized, holy crap, well, if this happens, I'm going to not be a trader anymore. I'm going to either lose all my money if I'm trading my own money, or I'm going to get fired if I'm trading for a firm. So, that's why all these things are so important. I don't know, Mark, what do you say? Should I just kind of go into a couple of these other second order Greeks here?
Yeah, let's skim on them really quick because otherwise people will write in saying, hey, what about this random one that you neglected? I think the skew one, you're right, is probably the most relevant. It's the one we dealt with the most often, even as a market maker, even though you didn't really quantify it. You kind of just came in and sat down and you tried to line up your skews, your call and put wing, or sometimes you wouldn't because you were convinced you were right and the market was wrong. And that was where you were usually seeing the lion's share of your P&L, because you're right, we always were delta neutral. We were you could never really be truly vega neutral because you always had some residual things up there, but you were pretty close, and we maybe had some decay, maybe it didn't, but it was the skew that would always get you, and so that was where the big fights came in, and the risk manager would say, no, you have to line it up, and you'd say, well, of course I'm right, the market will come back to me, why should I mark myself against it? Was the endless fight between traders and risk manager. It was always on that skew. So I'd imagine for even our listeners out there who are doing even smaller size. That's probably the most relevant of the bunch. We probably should touch on at least the others so we don't get those questions and have to go down this road again down the road, sir.
Yeah. So the idea is that, like all these first order Greeks they're kind of byproducts of the pricing model. And there's only so many dynamic inputs to the pricing model. So the idea is that as time passes, delta changes, and as time passes, theta changes, and as time passes, vega changes. And as the underlying stock price changes, theta changes, and delta changes, and vega changes, and implied volatility makes these things change too. So that's what these second order Greeks do, is they measure them. So, we're all comfortable with the idea of, okay, yeah, I know that delta changes when the underlying stock price goes up or down, because if an option gets more in the money, obviously its delta gets bigger. Well, that's gamma that measures that. And this is something that I teach. I teach a monthly class where like every month there's sort of a different series topic, and one, at least once a year I do a whole class on the Greeks. And we talk about this. We talk about how these dynamic factors change the Greeks. And so, like, one of the things that we look at is, as time passes, how does delta change? Okay? And that is what is measured by what is called charm. So that's not actually a Greek letter, but that's one of the second order Greeks. I mean, I don't think it's a Greek letter anyway. I was never a frat boy or anything, but doesn't sound like a Greek letter to me. And here's the concept. Imagine you're looking at $100 stock, okay? And you're looking at the 80 strike call. All right? So the 80 strike call is in the money by $20, 20%. No. Let's say the 90 strike call. It's $100 stock. You're looking at the 90 strike call. So it's in the money by $10, 10%. Not a lot, but whatever. So what would you expect the delta of that call to be? Well, I didn't give you nearly enough information there, did I? Because if today's expiration day and we're 3 minutes before the close, well, that thing probably has about 100 delta, right? Because one of the definitions of delta is the likelihood of an option expiring in the money. So that would have a huge delta if today's expiration day, and if it's 10% in the money. But let's say it's a leaps option and there's 2 years until expiration. Well, it's only 10% in the money. It probably has something like a 60 delta or something. So clearly, and that makes perfect sense, of course, right? Because there's plenty of time for something to happen. I mean, it could be in the money, could be out of the money, likelihood of expiring in the money. So you can kind of logically make the case for, as time passes, deltas change. So that is what charm measures. Now, staying on the topic of delta, when volatility changes, delta changes also. Now, that may seem pretty esoteric and like, how am I going to connect these dots in my head? It's not really that hard either when you really start thinking about it. So if you think about delta as the likelihood of an option expiring in the money, if we have $100 stock and we're looking at the 90 strike call, and we're looking at a stock that is like the most boring company in the world that, like, I don't know, maybe it's a company that people invest in and the company puts their money in CDs. Like, there's no volatility to the stock. Well, if the stock isn't really moving a lot, that call that's 10% in the money, it probably has a really high delta. It probably has a very high probability of expiring in the money, right? Because you don't expect the stock to move a lot. But if it's an extremely volatile stock, just whips around 20% a day, well, then the delta is probably a lot closer to 50%. 50%, of course, is the most uncertain. Well, anything can be, I guess, right? It's a coin flip. So the level of volatility clearly should and does affect the delta. So that is what is measured by Vanna. And then, I don't know, there's a bunch of other of these second order Greeks, and some are surely more relevant than others. Veta, for example, VETA measures the rate of change in the vega as time passes. So, there's that too, right? So let's talk about that. We know that as time passes, vega changes, right? Now, at first you might think, no, I don't know that, Passarelli. What the hell are you talking about? Well, my guess is you probably do know that because, or at least many of you probably know that, because if you look on an option chain at the vegas of some weeklies options, they're real small. And if you look at the vegas of some leaps options, they're really big. So, you can very easily observe just by looking at different expiration cycles in an options chain that the less time to expiration, the smaller the vegas. Thus, as time passes, vegas get smaller. So that is what Veta, VETA, measures. So I threw out a few of these here. It's worth, if you want to get crazy, do some Googling. I actually earlier today looked at the Wikipedia page on it, and boy, if you're a math nerd, you're going to have a really fun day looking at that Wikipedia page. But if you're not, you're not going to be on that page very long. But I'll caution you that there's not a lot of information out there on the second order Greeks, first of all. And second of all, I'm always very skeptical about complex information of any sort on the internet. I think that probably any of us who uses the internet a lot, you'll probably agree with me when I say that when you Google really complex information, you're going to find a lot of pages where there's just plain old wrong information. So, feel free to Google it. I know a lot of people at least used to beat up on Wikipedia, but I found that it's reasonably good, especially for what we're trying to accomplish here today.
Yeah, I'm looking forward to the second edition of your book, Dan, which is Trading Second Order Greeks, coming soon, right?
Yeah, Trading Option Greeks, Part 2.
The Second Order. It's kind of like the new Star Wars movie. The First Order, the bad guys. This is going to the dark side with the Second Order. Exactly. Yeah, that's our title. Going to the dark side with the Second Order Greeks. I like that. Might be a good one there. Might be a few downloads in that title, I think.
Yeah.
Well done, sir.
So and let me just close this with one more sort of reiteration. If you're trading 5 lots and 10 lots, you're not going to notice the effect of any of these second order Greeks. Possibly gamma if there's a gigantic change in the underlying stock. But a lot of these Greeks, like as delta changes as time passes and as all this business, there's such minute changes on your P&L for a 5 or a 10 lot trader that you're not even going to know. The story I told before about the guy who lost a bundle on skew, he didn't have on a 10 lot position in the treasuries. He had on tens of thousands of contracts, gigantic money tied up. So that's what these second order Greeks are really made for. They're made for professionals who trade very, very big money, who need to be able to understand the risk, like, oh, I'm delta, theta, and vega neutral. Where's my risk? Oh, here it is. And I can really only observe that by looking at these second and third order Greeks. They're for really big traders, not retail.
Well done, sir. So yeah, the moral of the story, the long answer, short answer to your question is, are they really relevant for retail? Not really. But enough people are interested in these things all of a sudden that it's worth at least putting them out there as a bit of a thought exercise, something for you guys to chew on. Of course, at the end of the day, like Dan said, if you're doing small size or if you're still kind of coming to terms with the primary Greeks we always talk about here on the show, delta, gamma, theta, vega, that stealth second order Greek in there, gamma, then that's where if you had to invest your time from a knowledge and payoff perspective, you'd be much better suited investing time in those and learning those, mastering the basics of things like delta and then gamma, the change of delta, and then of course theta, time decay, big to all you premium sellers out there on the dark side, as well as Vega, of course, the volatility impact of your things. And of course, a lot of you out there are trading weekly options, in which case you don't really have the time for any of this stuff to really kick in, except for a delta and some decay anyway. So these second order Greeks are kind of more esoteric at that point. But if you do get to that point someday, or if perhaps you're trading a little bit bigger size, 50 lots maybe and stuff like that, and you're starting to maybe hedge it with some stock, then you might find yourself encountering some of these ancillary effects of the second order Greeks, like the skew thing we're talking about, where you say to yourself, hey, I'm delta neutral, I'm mostly Vega neutral, why do all of a sudden I'm having a P&L shift? That's probably going to come from your skew. So there are times down the road where you may start encountering these. So it's worth being forewarned and indeed forearmed against them. But in the meantime, if you're just kind of cutting your teeth on options, this is way down the road for you guys. So don't really worry about it. Don't sweat it. But it's good to have at least some familiarity with the knowledge of it, with the terms, so that down the road you're not taken unawares. All right. And since we kicked off with some great questions, we might as well roll on into a full-on mail call here for the rest of the episode and try to work through some of the questions that have been piling up since our last episode.
Mail call. Time to look at questions submitted by our listeners.
I love the transitions on the show, Dan, because they always make me feel like it's summer, like it's July. Like I'm marching through a little parade ground with some fireworks going off when it's here in the heart of January in Chicago. So it kind of gives you a nice little warm bent to your day. This is, of course, the mail call listeners, a portion of the show where you guys take the reins, even though you guys have pretty much been in the driver's seat most of the show here with your great questions. Of course, you can send us questions a number of different ways. Questions at theoptionsinsider.com. Probably the easiest. Also, just surfing on over to the website. Use the comment system there or our website feedback form. A lot of you guys like to use that, or of course hit us up on Twitter. We're just at Options on Twitter. Find us on Facebook. Lots of you seem to like to write in via Facebook than Twitter. Twitter seems to, maybe it's that short 140 character count really helps you encapsulate your thoughts. I'm not sure what it is. We get the lion's share of the feedback via Twitter these days, and also the website feedback form. Not so much on Facebook, and of course stock twits if you guys are out there. We're just the Options Insider. So no shortage of ways for you guys to reach out to us. Of course, a lot of that is also baked into our mobile app, so you don't have to go too far to make your thoughts known to us here. Going to kick things off with AV56. He's got a timely question. He writes, hey, what's a good time to start trading options? Is there any certain time of the week or year that options traders are focused on? Well, Dan, we're probably the wrong people to ask this question to, because you and I are options guys. So we're going to say any time, right, is the best time.
Trade them up.
Yeah, trade them up to start trading options. But a little bit more serious answer to your question. Actually, that's why I said it's timely, because this is actually a good time to start trading. Maybe not this week, because there's some crazy stuff going on this week. We are recording this beginning of the year 2016 here, January 8th. Of 2016 for all of those of you who like to play the home game there. So there's a little bit of rocking and rolling in the market this week. So maybe not so much this week to come in and cut your teeth, but really this time frame is more what I'm talking about, the beginning of the year here. It's kind of a fresh start, a clean slate. People are trying a lot of new things. This may be a good time of the year to say, you know what, I'm going to try out these options things. And I've been listening to Mark and Dan drone on for episode after episode about all these various elements of the options market. And this episode aside, which is a little bit esoteric and arcane and scary, we've shown you pretty much over the lion's share of this program that options aren't scary. Options aren't really as mystifying as you may think. They're not as off-putting as you may think. And they're certainly not risk additive. In fact, if you use them properly, they're really risk mitigating. So hopefully you've taken that away at least from this program. And so you start small, you start easy with all the different paths we've outlined here on the show. Most of you are coming from the retail stock world, so you start there, and maybe you have a position you already own some stock on, and you say, hey, I would like to maybe get a little bit extra income out of this, so you write a call on it. Pretty basic, simple position. And you start kind of ramping up from there. Maybe you decide, hey, instead of buying stock on this name, I'm going to try a call instead, and you go that way. And then you go from there and say, the call was a little bit expensive. Maybe it worked out, maybe it didn't. Maybe I'm going to try a vertical spread this time. And you start adding layers to your trading over time. And now you're getting a spread with a good similar payoff project or probability, but you're less of an actual payout and outlay up front. Then you start learning more about other things, like we talked about using short puts and cash secured puts as a way, alternative to limit buy orders in a stock, a way to get paid for that limit buy order. You're taking the same risk either way. You might as well get paid for it. So the cash secured put is a good way to start doing your entries there, and at least improve your returns, get a little bit of payout there. And then, of course, you can start legging into things like wheel trades. We talked about before, leg into the covered calls. There's a lot of ways you could go there, but you start very basic. Simple, buy a call, buy a vertical. Maybe you buy a put if you're leaning to the south, to the dark side there. And then you start going from there. And then you start rolling. And then, so at the beginning of the year, a good time, new portfolio, clean slate. You're looking for some new ideas, some new income, maybe some new protecting or hedging strategies or things like that. You know, options are an easy way to go. We've outlined many different paths to do that on this program. So go through our archives, find the episode title that kind of applies to the way you think you want to trade. If you're looking for income, go to those episodes. If you're looking for hedging or spreads, go to those. A lot of different ways you can go. And then pick something that's not as terrifying to you. And maybe if you're really scared, start off in the paper trading. A lot of great brokers offer great paper trading apps. All have the same functionality pretty much as pretty much everything you're going to get in the paid account, because they want you to pay. They want you to become a paying customer. So they're not going to hide things and gate things on the paper trading stuff. And then if you can get access to that, then of course you start playing, you start kicking around, you see how things work. Doesn't cost you anything. And then eventually you transition to that mythical, magical first one lot, and you kind of go from there. What are your thoughts there, Mr. P? You mentor a lot of new options traders. When is there a good time of year to start trading options?
Yeah, I don't think there's necessarily a best time of trading options. I hear people say all the time all kinds of ridiculous theories. Oh, you should only trade from noon to 12:35. You should only trade, sell in May and go away, although there's some merit to that with options, but that doesn't mean be out of the market. It means sell and hold short positions. I don't know. I mean, there's always opportunities. There's always opportunities. And, if you look for cycles and trends, which a lot of people do, then, there's always a chance to get on the right side potentially of a cycle. I don't know. I mean, I don't believe there's a really great answer to that. I think you trade and you look for opportunities if you're a trader. That's it.
I think he means more like to cut his teeth, to get started. Is some time that's maybe more friendly for that. That's why I said we're kind of the wrong people to ask, because we always think any good time is good time to trade options. But yeah, I think beginning of the year has a certain symmetry to it.
And jump in the pool, man. The water's fine.
There you go. And if you need someone to hold your hand, you got guys like Dan out there willing to do it, and of course write the epic tome on second order Greeks for you as well. All right, moving on. Good question. This one comes from 777. He or she writes, how do you adjust your options trading for cheap stocks below $10? This is a good question. We talk a lot about cheap names on the website and on a lot of our programs on this network. We do a lot of unusual activity, obviously, on a lot of our other programs and on the site. And a lot of those names seem to exhibit a lot of unusual activity. They're disproportionately represented, perhaps, in those alerts that we do. There's always some cheap biotech where someone's buying a ton of calls, et cetera, et cetera. It's kind of par for the course out in that neck of the market. But there's a couple, and so you have to watch out for those kind of things, obviously, that when paper comes in, it tends to be pretty one-sided in those types of names, and that gets into all sorts of other things that we talked about on the show in the past with one-sided paper. But the lion's share of these names that are south of $10, and indeed particularly south of $5, they're usually there for a reason. They're not particularly desirable names. So you're not going to have a lot of people out there playing in those. For the most part, there are exceptions. Back when Citi was $4 and a lot of people were arbing, doing fee arb back and forth in that name. There's a lot of paper in that name for a $4 stock, but it was mostly garbage. But that said, there was a lot of liquidity out there. So there are names that are exceptions to this, but for the most part, a lot of these names, sub 10, particularly sub $5, are going to be pretty thin. And so when you come across these thin names, you're going to have all the problems we talked about before about thinly traded names, particularly very wide bid-ask spreads. And that's going to add a demonstrable cost to your trading out in these names. You have to be really certain that you really want to trade out there, and you have to babysit your orders a little more, work them a little more, and also because there's no one playing out there, the probability of someone stepping up and trying to fill you near mid-market is pretty small because no one has an incentive to do it because they're not going to be able to get out of that trade. So you're going to have to probably hit bids or lift offers or pretty darn near to it in order to get anything done out there. So if you're okay with that and the cost and inherent cost of doing that, then that's probably the biggest thing you need to be concerned about when trading a stock, options on stock below $10. Of course, Dan, there are those out there, maybe you're one of them, who just poo-poo trading options on cheap stocks altogether. They say, hey, the stock is essentially an option at that point. In fact, we did an unusual activity alert the other day on a guy paid, it was a stock that was trading about $7.50 or so. And the guy bought a 2-year out 9-handle call, so far out of the money call. And he paid like $3 and some 10 cents, I think, to do it. And I said, well, that's an interesting trade, but he bought the stock on margin, paid about $3.50, so and had the stock. So it's a weird one. So yeah, exactly. So first off, obviously margin has its own issues, but first off, what are your thoughts in general on options on cheap stocks? Are you nay or yay? And then B, do you have any caveats for those?
Yeah, man, you stole my joke about those are options. You just don't know the expiration dates. I was waiting to say it.
I was way ahead of you, sir.
Well, you know what? I mean, they're crap for trading options because your commissions are, generally speaking, somewhat fixed as a retail trader. And so if you're buying a call for $20 on, I don't know what, Priceline or $50 on Priceline, you're paying your 80 cents in commissions. Or, well, let's just round it to $1 in commissions. That's a penny of option premium. But you're buying, a 7-cent call on a $6 stock, and you're paying a penny in option premiums. That's like, 1/7 of your profits. And then when you get out and pay another penny, there's 2/7 of your, so you're at an extreme disadvantage because of commissions. You're probably, in a lot of cases, at an extreme disadvantage because the bid-ask spread percentage-wise is probably going to be obnoxiously wide. I mean, probably not in Citi because there was, when it was at $4 because there was so much paper going back and forth. But, if it's like joeshotdogs.com that's trading for $3, the options are probably going to be 2-cent bid at 10 cents. That's insanity to trade that. There's not the liquidity. I don't know. I mean, I advise people to only trade liquid stuff, and low stock prices detract from option liquidity, per my definition of option liquidity, bid-ask spread. So I don't know. I advise people to look for options $20 or higher, personally.
Dan trades not but Apple and Priceline and Google.
Yeah. Well, wait, let me clarify that. Not options $20 or higher, but options on stocks that are $20.
I'm giving you a hard time, sir, because it's so fun. Yeah. All right. So speaking of giving a hard time, we got a comment here. Not us, but other people he's giving a hard time to. This is Brian F. He snuck another one in. He, of second order Greek question fame, he sent a comment in too. He says, hey, I went through the options bootcamp shows twice and read a few books and now have the bug for options. So there we go, Dan. We're doing our duty, luring people to the dark side of options, one listener at a time. Went through the whole show twice, so good for him.
Wow.
He's a dedicated listener. And he also sent in a great question about second order Greek, so he's paying attention. He goes on to say, have you perused the options videos on YouTube? Is it me, or are most of these people idiots? Thanks for the education on options. I now have a way to screen the real trading educators from the BS artists. And he didn't put the BS in there. I added that. He was not family friendly in his things. But yeah, he's. I share your pain, Brian. There is a reason why we do things the way we do them here at the Options Insider and on our radio network. There's a reason why we work with people like Dan and not maybe some of the others that are floating around out there. Options have a bad enough name to begin with. If you start getting into the weeds of some of these more shadowy type figures who claim to be educators or gurus or whatever, and for whatever reason, there's a lot of them in the options world. I'm not sure why options are so cater so much to that mentality, but they're out there en masse. you're right. There's a lot of ways to throw good money after bad people in the option space if you're not careful. That's why we don't hawk a lot of stuff here on this show. I try to give you education. You guys know where we're coming from all the time, and so that way you guys can come on and just kind of get some good edumacation, and then go on about your way, and no one's scamming you or ripping you off or that sort of thing. And so yeah, that's kind of my thought. Dan, I know you do. You do some videos over there at your Traders Reserve, so you're active in that space. What are your thoughts on Mr. Bryan's comments here?
Yeah, well, I don't know. I mean, I don't want to jump on the bandwagon here. I think we have an astute listener.
It's fun to be on the bandwagon. Go ahead.
Yeah. No, I mean, yeah, I think we have an astute listener who it's like anything else, man. Caveat emptor, buyer beware. I mean, if you get see some crazy YouTube video with some guy where it's raining dollar bills and he says sign up for my service and you sign up for it and lose money, you probably weren't going to make a good option trader anyway because you're too easily fooled. So
I need that.
I don't know. So maybe it's a good filter to have those guys out there.
I think I need that raining dollar bills background / wipe for my videos, and that's going to look good. I like that. Where do you get that? I want that raining dollar bills.
Right. I literally, I kid you not, I have seen that.
Doesn't surprise me at all. Some of the things I've seen on some of the video, and also at the trade shows and things. Yeah, we can go on for quite a while on all that good stuff. Instead, you're very astute. I echo Dan's sentiments there, Brian F. And let's move on now to a question before we get in trouble. A question from Max. Max S. He writes, I have a lot of Apple in my IRA. I think you're not alone there, Max. He goes on to write, but I'm worried about the downside potential going forward. This one came in a little while ago, so hopefully we haven't done a show in a little while. Hopefully he's had a chance to do something about that downside in Apple since then, because the stock has been taking it on the chin of late. He continues, I don't want to liquidate that position for a variety of reasons. I have some free capital in my trading account with Firm X. I won't mention them. Does it make sense to potentially pick up a few Apple puts in that account and use them as a hedge against the position in my IRA account? Also, if I switch that trading account from Firm X to my IRA custodian, will the firm treat those as offsetting positions? Thanks for the show. Well, a lot of great questions in there. A lot of people write in with variations on this theme, Dan. I'd imagine you probably spend a lot of time in some of your mentoring sessions working with people who want to hedge things in their IRAs, but for a variety of reasons, maybe they can't do it or they don't have the capital there, et cetera, so they have to use other accounts and kind of hedge back and forth. It's a bit of a kludge, listeners, but it can be done. It's a very frequent use case for options, that people have concentrated stock positions in for whatever in some retirement account, and they can't liquidate it like our friend here, but they want to hedge. Maybe they don't have the money in their IRA. They frequently will hedge it in a traditional brokerage account, something like that, wherever they have the free capital to do that. It's not as attractive sometimes to do that because then you have one account that's doing well and another account that's doing nothing but eroding and bleeding money over time. So that can be a little bit demoralizing for people. But if you can handle that psychological hit, there's nothing wrong with doing that. As opposed to the last part, if you're going to have a brokerage account and a kind of IRA account with the same firm, are they going to use those as offsetting positions? No. IRAs are kind of different beasts. They kind of work in a little bit different regulatory environment than traditional brokerage accounts. So it may make sense to you, but from a lot of different regulatory reasons, it's not really going to happen unless you're a really sizable customer and you have a bunch of accounts with a different firm, in which case they'll be willing to try to make some concessions for you and do some stuff with different accounts. But 99% of the time, yeah, that's not going to happen. Mr. P, any thoughts about trading options outside of an IRA account to hedge positions in an IRA account?
I don't know. I mean, you summed it up pretty well, Mark. I mean, I can't imagine there's many companies out there that aren't going to let you buy a put to protect your stock in an IRA, right? I mean, is he saying that his firm won't let his brokerage firm won't let him buy a put in his IRA? Is that what he said?
I don't know. I kind of got my reading of it was that he was kind of fully invested in that account, and so he didn't have more capital to buy the put. But he had it in a separate account, so he was going to buy it in his brokerage account, and then kind of look at the two as kind of combined in his eyes.
Yeah, I mean, Mark really hit it on the head when he said, there's that psychological impact, because then you're going to say, well, wait a minute, I'm losing money in this account. That was stupid. And that can be difficult. And B, I mean, I will say that simply going and buying a put to hedge a stock is usually the worst way you can do it. I mean, I know that that's what they teach you in the basic level textbooks. Like, yeah, this is what you use puts for. They're protective puts. You buy your insurance policy, but I've seen people who are worried about a 5% fall and they buy a put for 6% of the value of the stock and they let it erode. And then they say, oh, well, look, I'm protected. Well, yeah, but you lost more on the put than you would have lost if you didn't buy the put. So I don't know. I think there's better ways to hedge. You got to be a little bit more sophisticated, but you just get a little creative and sit down and think about it, do some ciphering. And it's fine. And if we're talking IRA also, you have Apple in there and you're worried about that the, Pax Romana of Apple is over. I mean, hey, baby, all things must pass. Like Apple had a really good run for a number of years. It's not just going to go up forever and ever and ever and ever. I mean, you think it's going to go down, sell it, right? I mean, I'm not necessarily telling you to sell it, but I'm saying if you're not bullish and you're holding a stock, you do some soul searching, baby. Why am I holding a stock that I don't think is going to go up?
Headline here, Dan Passarelli says, liquidate all of your Apple holdings at the earliest convenience. And it doesn't work out for you.
Make sure you throw some extra legalese at the end of this podcast.
Yes. All right. We got time for a couple more quick ones. Since we're talking IRAs, we got a question from TJD. What's the story on using options in my IRA? Is that still legal for 2016? Dan, I'm not sure if you're up on what he's talking about, but on our advisor's option program, we've been talking a lot about, there was a big kerfuffle towards the end of last year where there was an exemption coming out of all places, the Department of Labor, that kind of clarified what kind of positions you could hold in a retirement account and what you couldn't. And one of the ones, surprise, they didn't lay out was options. And so a lot of people really lost their minds on that in this space, as you might imagine. Depending on the numbers you look at, IRA activity accounts for about 15% or so of ADV in the options market, so they obviously don't want to give that up without a fight. So a lot of pushback against that proposal. It seems like from the legion of angry comments that the Department of Labor received on that proposal, that they saw the error of their ways and they're going to correct that. They're revising it now. It's in all these kind of committee revisions and there's more proposals and comments going on. So it's lost in that kind of bureaucratic minutia. But it seems like the early indications are that they got the message and that you will be able to continue using your options in IRAs for the foreseeable future. So that was a bit of a scare there, Dan, but it seems like we're out of the woods there. Of course, now that I say that, who knows? You never know with Capitol Hill. They're kind of a weird bunch. But at least for now, it seems like we're safe. And we'll wrap it up with a comment. This comes in from Matt. He's the stock entrepreneur. I like that. He writes, hey, huge fan of your shows. I've been binge re-listening to Options Bootcamp as I prepare for a new year of options trading. Thanks. Well, you're welcome, Matt. We love to help you guys. We love to put out great content for you guys to peruse at your leisure. A lot of you saying you've been binging the show, doing a bunch of them, or re-listening to old ones. We set up the show particularly with that use case in mind. You can come in and gobble up a bunch of them, and then certainly go back over time when you're looking at maybe you're adding some new weapons to your trading arsenal and you want to hit back again on that show we did a year or two ago about that particular topic. Go ahead. That's why this show is set up this way. Easy access for you guys to not just the new stuff, but the archives. You can go get it anytime you want, 24/7. So feel free to binge away, Matt and everybody else out there, and re-download, re-listen whenever you like. We know a lot of you guys love this show, so I want to keep doing it. We're looking forward to 2016 to getting us back with Options Bootcamp on a much more frequent schedule. We kind of got waylaid and sidetracked with a bunch of other projects last year, but Options Bootcamp we know is really popular and meaningful for a lot of you guys out there. So don't worry, we're going to keep rolling on from it. So Dan, that's about going to do it. You have any last words you want to share here with our boy Matt, who loves our shows, as well as everybody else out there, all of our listeners out there? Go ahead, sir.
Binge away, baby. Binge away. The more you learn, the more you earn when it comes to option trading. There's no magic bullet. There's no secret sauce. Learn, and you'll be a better trader for it.
There you go. And speaking of learning, Dan, a little birdie has told me that you may have a nice little webinar coming up that some of our listeners may want to check out. Why don't you give them a little bit more info on that, sir?
I do. I've got a real special event coming up on January 23rd. And it is 7 tips for trading in 2016. This is just for option traders. That's you. And you can register for that webinar. Again, it's on Saturday, January 23rd, by going to markettaker.com/7tips. So market, like stock market, taker, like take something. So we got 2 T's in a row. markettaker.com/7 tips, TIPS.
There you go, listeners. Check it out. We think you're going to like it. You have plenty of time after the show comes out to register. And for all of you guys who come out after the fact, we know you guys like to come gobble up this show weeks, months, and even years down the road. I'm sure Dan will have some great archives for that event on his show for you, or maybe have some sort of other way for you guys to access it, so you probably won't have missed out either. So check it out, and of course, keep up with all the cool stuff Dan's working on over there at Market Taker, mentoring him and the team over there, doing a lot of cool stuff. I hear you're in the process of announcing deciding your big 2016 retreat.
Oh, yeah. You know what? We signed the contract yesterday. We know where it's going to be. I'll give you guys a save the date. It's July 22nd and 23rd. This is our 2-day on-location, in-person class. We picked a freaking amazing location for this. Last year was in Sonoma Valley, California. It was wonderful. This is going to be even better. We've got great surprises for you. July 22nd and 23rd. I can't tell you where it is yet, but next boot camp, listen up, because I think we're going to tell you that.
And I think my first class, all expenses paid ticket to the retreat last year somehow got lost in the mail. So I'm looking forward to my invitation this year.
Yeah, definitely keep an eye out for that. Yeah, you should be fine.
I usually like the Concorde, so something of similar prestige and class for my transportation. That's all I ask.
We'll have the Millennium Falcon come and pick you up.
I like it. Well said, sir. On that note, that's going to do it for this episode of Options Bootcamp. Thanks for sticking with us. Thanks for coming in and downloading and binging and re-downloading the show. We know the show means a lot to you guys, so we're going to make sure we keep cranking out episodes, and we're working on getting them out even more frequently for you in 2016. So stay tuned for those and more episodes of Options Bootcamp coming down the pike in 2016.
Options Bootcamp is produced by the Options Insider, Inc. All rights reserved.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.